Hi, good afternoon, everybody. I hope that you're having a wonderful day. Um, so I know on my Facebook yesterday I had promised to have this video uploaded by last night, but life. I had a closing yesterday. I'm working with different clients, running errands and cooking dinner, kids, and just life. Realtors have life too. But nevertheless, I'm here and I'm going to share this information with you today. Before I get into it, I will kindly ask you to like or subscribe, share my channel, share my videos with anybody who you think could find this information useful, helpful. There are a lot of great realtors. They're amazing at what they do. But a lot most of them just don't have the time or the patience to teach it. I do. I love teaching. I love to see, people's eyes light up when they receive new information that helps them feel empowered, to move forward, to take that leap and take the next step in the home buying and home owning process. So that's why I do what I do, and I hope you guys find the information helpful. And so I just ask that you share, so that other people can benefit. I don't care to have 10, 20, 100,000 followers. I really just genuinely truly want to reach the people that want this information, the people that are afraid to buy a home because they aren't getting the education and the information that they need. That's all. So with that, I'm gonna move forward. Let me lead by saying that I am not a loan officer. I'm not a lender. I'm a realtor. We have two different jobs. We work very closely together to get you in a home, but mortgage and real estate are two different jobs. We have two different jobs to do. But I work very closely with my lenders and I learn a lot from them so that I can better assist my clients. Now, I'm not trying to do their job. I don't want to do their job. I love my job, but I want to be able to help my clients more than the average realtor. So I learn a lot of the mortgage side of it to be able to answer, basic questions and things. So what I'm going to talk about today is a mortgage thing, but I'm not a lender. I sat down with my lender yesterday to get more information about, this news that was put out about lowering mortgage insurance, which is great news. Every little bit helps, right? So that's the big news. FHA HUD has decided to decrease the mortgage insurance rate. This can go in so many different directions. So let's start with this. What is mortgage insurance? Mortgage insurance is insurance for your loan, not to be confused with homeowners insurance. So within your monthly mortgage that you pay, we're talking FHA, there's 5 components that make up your monthly mortgage payment. One is your principal. That's the amount that's actually going to the home itself. Your interest, that's the amount it costs to borrow the money. That's the money it costs to borrow the money. Property taxes, homeowners insurance, and mortgage insurance. 5 things make up your monthly payment. So when you lower your mortgage insurance, that lowers your monthly payment. So that leaves a little bit more room in the budget for you to, be approved for more or even be approved at all. Some people just don't qualify because of their debt to income ratio. But if the mortgage insurance is lower, then that lowers your debt to income ratio and that helps you qualify. That could literally be the make or break of being approved or not. So let me explain the difference because we don't want to confuse mortgage insurance and homeowners insurance. Homeowners insurance protects your house, the actual property itself, the structure. Mortgage insurance protects the loan, the money it costs to to purchase the house. So your lender, when you apply for a mortgage, you get approved, that lender pays the seller in full for the house. So every month you're paying the lender back until that loan is paid off. So as long as you have a loan out on your house, it's considered a liability. We like to protect our investments, right? So the mortgage company is telling you that, okay, we lent you, you know, $350,000 to purchase this house, but we want to protect our investment. The mortgage insurance, you know, it protects you from, it protects the bank rather from, you know, things like foreclosure. If you default in your loan, they won't be at a total loss because you've been paying mortgage insurance. It's a lot like auto insurance. When you purchase a vehicle and you finance it, that bank is giving that dealership the full amount. They paid that car in full for you. But now every month you're in your car note, you're paying the bank back. Well, because you still have that obligation, you still have that liability, the bank is like, we want to protect our investment. So we require you to have full coverage insurance in case you get in any accidents, at fault, no fault, or theft, damage, anything like that, your insurance is going to cover it. So the bank is not at a total loss for the money that they paid for their car. Same thing with mortgage insurance and loans. They want to protect their investment. So if you default or, you know, just let the house go, they're not at a total loss because you've been paying the insurance on that loan. So back in 2008, when we had that really bad recession, a lot of people went into foreclosure. Insurance rates are based on what's happening. One, they look at your credit worthiness, of course, just like auto insurance. They pull your credit, whether it be a soft pull or a hard pull, they pull your credit. They look at your credit worthiness. And then it also depends on what's going on, like how many break-ins are in your area. That's why they need your address of where the car is going to be kept. They want to know how many accidents have been reported in that area, how many thefts, break-ins, all of that. That's how they kind of come up with the premium for you. Same with mortgage. How many foreclosures have we had in their area? You know, different things like that. That's how they come up with your premium. Now, FHA has had this standard rate. When that crash happened, 2008, the mortgage insurance rate went up to 0.85%. It was lower than that before, but because of all the foreclosures, they had to raise the premium. 0.85%. How does that affect you monthly? So you have your purchase price and you have your loan amount. What's the difference between the two? Purchase price is the full amount of that house. If that house is listed for $375, that's the purchase price. You know, if that's what you got a contract for, $375, that's the purchase price. But with FHA, you know, you're doing 3.5% down. So you're taking 3.5% of $375 and $375,000, and you're paying that portion in cash. The rest of it you're borrowing. So your loan amount is the portion that you borrow. And so that's how they calculate your mortgage insurance. They do 0.85% times that amount that you borrow. And then you divide that by 12, and that's how much you're paying every month for mortgage insurance. But HUD just released that they have finally now decreased that from 0.85% to 0.55%. So what that essentially does is it lowers your mortgage insurance, which lowers your monthly payment, which lowers your debt to income ratio, which now gives you a little bit more buying power. And sometimes that could make or break your approval. You know, some people, once the lender puts in that mortgage insurance, it suddenly takes your debt to income ratio too high. But now that it's been lowered, that could be the make or break that can make or break the deal for you. Now that it's lowered, somebody's going to get approved now, because the monthly payment is going to be lower, which lowers the debt to income ratio. So that's why this is exciting news. You know, it's not like a whole lot, but to some people, every dollar makes a difference. $10, whether it's $10 savings per month, $20 savings per month, 30, 40, however much it is for you, like I said, because it's a percentage of your purchase price. So it's going to be different for everybody depending on what your loan amount is. It helps. I mean, I know when we have clients that get pre-approved and they're under contract with the rate, but then rates drop, and when the lender changes your interest rate and it lowers your payment by $10, people get excited about that. So it's the same for the mortgage insurance. Even if it lowers your payment by $15, people get excited about that. So so that's the great news. It's going to lower your monthly payment, and you know, your debt to income ratio, all of that intertwines with each other. So that is mortgage insurance. I hope I covered everything. Oh, let me add that this goes into effect March 20th. So if the way they're doing it is if your loan is endorsed for insurance on or after March 20th, then you qualify for that new lower rate, 0.55% times your loan amount. So for those of you that are already under contract right now and you've already been endorsed for insurance, you may not qualify because it's before the effective date of March 20th. So keep that in mind when you are, for those of you that I'm working with that are going through the pre-approval phase and everything now, keep that date in mind. March 20th, that's when it goes into effect. So I hope this information was helpful to you guys. Please let me know if you have any questions. If I can confidently answer them, I will. If not, I will find out for you. I will ask my lender anything that I don't know, myself. I will definitely try to get you some answers. So thank you guys for listening, and thank you again for sharing. Have a great one. See you next time.